Oh, it started 69% off a flash sale for any of the programs on building your wealth or the shadowing experience. More on all of these later, but dang, 69% off a flash sale for Valentine's Day. Check that out, link down below, and it has officially begun. And remember, that's a flash sale. That's an investment in yourself for programs on building your wealth. And since these programs are an educational expense and tax season is coming up, remember, these programs could be a perfect tax deduction for you. Check with your CPA, but investing in yourself or your business could be the perfect tax deduction for you. Take advantage of that 69% off flash sale before it's gone. Tesla, wow. Okay, we got to talk Tesla because Morgan Stanley just came out with a piece on Tesla, and it was actually surprisingly bullish, dare I say. Usually Morgan Stanley seems to be the master of bears, especially if you start listening to that Mike Wilson bear. Boy, he is a mega bear. You just can't get through anything. But he's more of a larger macro bear. And this, we got to talk about Tesla. So before we talk about the Morgan Stanley piece on Tesla, it's just worth noting that Hertz has officially taken delivery of roughly 50% of the 100,000 Teslas that they ordered on hand at the end of the last quarter in their Q4 earnings call and report. They reported that they had 48,344 Teslas on hand. Remember that Hertz, as a rental car company, likes Teslas, not only because people, when they go to a destination, want the potential of being able to rent a Tesla, but also they have a large portion of it, or a large portion of their Teslas dedicated to Uber drivers. And so really what they're trying to do, especially during a period of potentially higher gas prices, is going to Uber drivers and essentially being able to say, hey, look, why don't you just rent a Tesla from us? Use the supercharger network, but rent a Tesla from us and use that to make your Uber drives. And a lot of people who get into Tesla Ubers are actually so excited about the idea of being in a Tesla Uber that, at least anecdotally, when I get into a Tesla Uber and I talk to the Uber drivers, they talk about one of the most beautiful things about having a Tesla is everybody thinks they own the Tesla, and then they tip more. So people are getting larger tips renting Teslas from Hertz because people are like, this is so cool. I get to experience a Tesla in an Uber. Thank you for having bought or leased this Uber to provide it for me as a taxi. And meanwhile, they're just renting them from Hertz. It's honestly kind of brilliant, and then they're getting more. And so it's like it's win-win-win, right? It's win for the Uber customer, it's win for the Uber driver, it's win for Hertz, and it's a win for Tesla. Now, what's phenomenal is Hertz ordered 100,000 Teslas, so you still technically have another 50K to deliver. So TBD, what's going on with the other 50K, whether it's production or deliveries, or maybe there was some kind of price renegotiation, given some of the recent price drops, and maybe Tesla's pissed. I'm just making this part up, right? In theory, it is like if I were Hertz, I'd be like, yo, y'all just lowered your prices. We want to take advantage of those lower prices. Although Hertz did announce their original buys before some of the price hikes, but it would be very interesting to compare what Hertz agreed to pay for the cars versus what they are now, and who knows, maybe there's some disparity there. There's also some news regarding full self-driving beta 11, essentially just that it's taking a little longer to launch, in that Elon Musk suggests it's basically harder than expected, and to get it out, and now saying there might be a limited beta release for full self-driving 11 next week, but Elon Musk's next week tends to be next month, so buckle up. But what is interesting is the Morgan Stanley piece on Tesla. So let's pull up that, is right here. So Morgan Stanley here has their headline listed as Tesla over $200, too much too soon? 5 key thoughts. So we'll also look at their price target and how they arrive at their price target in just a moment. But they start off by talking about how over the last 27 days, Tesla has accumulated somewhere around a trading volume of $804 billion. By comparison, the 27 days leading up to the end of the calendar of 2022, Tesla had only accumulated around $525 billion on trading volume. Now, what's interesting about that is I think you had a lot of dumping of Tesla stock at the end for tax loss harvesting purposes at the end of 2022. I'm not exactly sure if Morgan Stanley has made an adjustment here for that, so we'll see. On sentiment. So in other words, they're basically trying to say, look, we think it's relatively overbought at the moment. That's basically what they're trying to say. Which, I mean, if you just look at some of the simple technicals like the RSI, Relative Strength Index, you'll see that as well. On sentiment, they suggest that at Morgan Stanley, and this is sort of like, I feel like insider information, but it's fascinating. On the inside, Morgan Stanley suggests that more of their customers are all of a sudden calling to invest money into Lear, which manufactures corporate jets. I actually think these smaller corporate jet companies have phenomenal pricing power just because of the aerospace shortages that exist. Embraer being another one. If you want a Brazilian company, that's ERJ. I have exposure to that personally, and I don't to Lear. So in fairness, I just want to be transparent about that. HOG is the Harley Davidson motorcycle stock, obviously here. And Morgan Stanley suggesting they're receiving more calls to invest in Lear and Harley Davidson than they are over Tesla. And they call this highly unusual. And so they suggest that maybe there's some resistance that's sort of lining up with sentiment and the technical saying, hey, short-term Tesla, maybe less interest. Although who knows? I think if you go back 6 months ago and you told somebody, hey, you could buy Tesla for $200 a share, I think people would have loved the opportunity at that. I think, then again, May, June, we were sitting around 215. But we were sitting around 300 for a while there in July and October. So I guess it depends on which part of the last 6 months you're looking at. Anyway, so then you have valuation. Before we look at that, take a look on screen here. We've got the largest flash sale on a percentage basis that we've ever had, 69% for any of the programs on Building Your Wealth. And this includes the stocks course, real estate courses, income courses, and even the shadowing experience, which is really incredible. Now, which one's right for you? Well, I'll tell you this. Most people get started with either the Stocks and Psychology of Money group or the Zero to Millionaire Real Estate Investing course. In fact, a lot of people use these flash sales to bundle up between the both of these programs. This is how you're getting great pricing on both of these together. Now, the Stocks and Psych group is coming with a new trading challenge where my team and I work together to take all of the research that we do and then think of what we think as the best and most likely to succeed trades. And so we'll be posting those regularly for those of you in the Stocks and Psychology of Money group starting this week, which is very exciting. You also get updates and insights into my personal moves. Am I selling Tesla? Have I sold Tesla? What am I buying? You get that trading intel, fundamental analysis, short-term, long-term trades. Real estate, you get, if you're looking for your first house, your first rental property, you want to use a property manager, Zero to Millionaire Real Estate. This is how you get the best wedge deals, my opinion. A lot of knowledge in this course. You want to go into managing properties yourself. You don't just get me, you get professional property managers interviewed in this course as well. Some incredible insights to make sure you don't get ruined by tenants. You want to grow your income as a real estate agent, as a social media content creator, or you want to grow your income as an employee or other self-employed person. Check out the Elite Hustlers group. Remember, a lot of these programs are tax deductible. Check with your CPA. You can also shadow me. Now, I don't sell transportation. Remember that you're not paying for transportation. So if you want to come shadow, you got to pay to get yourself out here. Obviously, if I go drive somewhere, you can come with me. It's incidental to what you're paying for. You're paying to shadow me, right? You're not paying for transportation. If we go fly somewhere, then that would be included as well. Now, I want to be very clear. You're paying to shadow me. That should be very obvious. Anyway, with these programs, though, you get lifetime access to all of the new content that's added to them as well. But hopefully you've appreciated this breakdown and take advantage of that 69% off flash sale through Valentine's. Competition talk. Let's hit competition first. They say, Morgan Stanley here, that we continue to believe that Tesla will short-term invest their margin into lowering prices. Now, I think that's a really interesting argument. The way they phrase that, investing their margin into lower prices. That's fascinating because we know that Tesla's thinking they're probably going to get down to about 20% margin, gross vehicle margin. They've already warned us about that. And right now they're sitting around like 25.8% gross margin. So we're expecting to see a hit there on gross margin as they cut prices and they go through a full quarter of price realization through Q1, Q2. That'd be 2 full quarters. But anyway, so we expect those margins to come down at Tesla, but Morgan Stanley is actually suggesting Tesla making or cutting their prices is them investing their margin into market share. Now, this is something that we believe as well. We agree. We think them pushing their prices down makes everyone in the industry lower their prices, which basically means Ford and likely GM are going to lose more money per vehicle they manufacture in electric vehicles. Rivian and Lucid will go deeper into losses and potentially go bankrupt. And you'll see companies that are barely profitable on electric vehicles like BYD potentially go negative. Now, who knows, but this is something to pay attention to. And I love the framing. Maybe I just love it because obviously I'm bullish on Tesla. But maybe I love that framing because I'm biased, but to be clear. But it's a fascinating way to think about a lowering margin, that you are just investing that in the short term, your margin, taking that loss on margin or lower margin, investing it into more market share, then you get the benefit of network effects of potentially more market share in the future and squeezing out your competition. And then longer term, Morgan Stanley says we expect Tesla will invest their additional margin into innovating to grow their margin even more. As first, they drive consolidation amongst the EVs, in other words, forcing bankruptcies or getting people out of the industry. And then once they're more dominant, they profit even more. It's kind of like a 4D chess move, and I ship it. Or in an EV video, do you say you drive it? That doesn't sound as good. Anyway, we'll talk about their valuation in just a moment. Catalyst, they list here Master Plan 3 expected to be unveiled March 1st. We're excited to see progress on the manufacturing side, including the GigaPress front and rear, the 4680 battery pack, structural pack, and other innovations, including supply chain, upstream material sourcing, and mining. Notice that they don't mention anything about the next platform for Tesla vehicles, which I think is really just going to be an innovation for margin. Some people are speculating that, there's going to be a new Tesla that it gets announced. I don't think so. I think that's highly unlikely, and people are setting up to be disappointed, which could potentially create this buy the rumor, sell the news trading opportunity. But Morgan Stanley remains overweight on Tesla, and the reason they do is they have a price target here of a 220 for Tesla. Now, if you're asking to when, it's today. So their today's price target is 220. That's because they're discounting their 2030 expectations by 9%. So basically, if you invest today at exactly $220, they believe you would see a 9% return year over year over year over year over year going to 2030. I'm just sort of re-engineering the math to explain it a little bit more simply than starting to get into WACC, weighted average cost of capital, and discounted cash flows. I personally do my valuations a little differently. I come up with a valuation, and then I look and say, okay, what is that going to return me compounded annually for the next X years through my valuation? And the reason I like to do that is because that's a lot easier to come up with than a discounted cash flow statement. Now, don't get me wrong, I could do discounted cash flow all day long. But the problem with DCF, in my opinion, is you end up screwing with too many variables. And what I found is as soon as you start screwing with too many variables, you get confused and you don't even realize all of the adjustments you're making to those variables. I think it's a lot easier to do it in a different way, the way that I like to do it. I come up with my sort of valuation, and then I work backwards to see, is that valuation what I'm willing to invest at? Long story short, I'm oversimplifying here, and I know it. But anyway, Morgan Stanley has a price target of 220 today, and if you invested at 220 today, going forward, they would see that would yield you about a 9% return, which per year. Now, upside risks, they see potentially increasing the full self-driving take rates. I agree with this. However, something that offsets more people buying FSD is this potential that you end up getting more people signing up for full self-driving using the monthly software as service approach rather than paying $15,000 out of the gate. Now, when you buy the vehicle, you could finance the $15,000, which is great, and still end up getting your energy credits, which again, that's fantastic. That would be great. But if you don't finance it up front, because you want that lower monthly payment and then you add it on later, I think people are going to go for the sign up for the full self-driving at $199 or $299 a month rather than, depending on which level you get, rather than paying 15 grand. So I think that's a risk to actually thinking that FSD is going to be very, very profitable in the short term, although Tesla is starting to incorporate some of the profit from FSD now that they've more widely released it into their earnings models. When they report earnings. Obviously, some upsides could be really scaling the Cybertruck semi-truck, and then they mention here a multivan. Now, I think multivan is a market that Elon is absolutely excited about, and they're absolutely going to get into. I don't think they are right now because I think the presses that you would need to put together these vehicles would be substantially larger than the presses they're creating now. Think about pressing like a a Sprinter van versus a Model 3, right? The press you would need would probably have to be 2 to 3 times as large for a multivan, like a Mercedes Sprinter van. Now, the reason they call it a multivan is because it could be a passenger van or a cargo van, but that is the next frontier. I promise you that is going to be one of the hottest markets for Tesla. If they could come out with a passenger / cargo van after the pickup truck, that is going to be such a game changer. Now, that's just a rumor right now. Nobody actually knows if they ever actually will. We know that Elon Musk himself is a fan of the Mercedes Sprinter van, as am I. But I don't think we're close to that yet, given just the manufacturing engineering that would be required to do in a margin efficient manner. So I think we've got a little bit of a wait for that. Certainly, I think this decade, and that could really create an entirely new S curve for Tesla. So that's pretty exciting. But that's more of like icing on the cake. You don't want to buy Tesla stock because you think they're going to come out with like a Sprinter van or whatever. A Corset creator here writes, a Tesla mom van? Oh, yeah. So that actually is something that is missing from Tesla's lineup, is Tesla does not actually have a good mommy car. Now, in fairness, right now, their market is really 25 to 45-year-old dudes at like a 70 to 80% market share for that market. So they're not really trying to appeal to women. I think that's a big mistake. I actually think they need to have a more mommy functional van, and they don't have that right now. The Model X or Model Y are not great for mommy vans, in my opinion, unless you have like just 1 or 2 children. As soon as you get more than 2 children, and even if you have 2 children, the trunk space is a big issue, especially if you got to put a stroller and groceries in there. There's just not enough room in these vehicles. Certainly if you're going to use the 7 or 6 seat configuration, you have basically 0 trunk. It's like impossible to get a full family in the Model X or Y. It's very, very tight, especially with car seats. It's just not functional. Now, I personally do think the Model Y is the best vehicle that you could buy from Tesla. So if you're going to buy a Tesla, I think you should absolutely focus on the Model Y. The Model Y was just actually increased $500, and the Model 3 was reduced $500 right before the Super Bowl kickoff. I thought that was really interesting. And it doesn't surprise me, though. The margins are better for the Model Y, so that benefits Tesla. But I actually think that's a win for the consumer as well, because the Model Y is just, you get so much more space for not that much more, and on a range point of view, I think you get plenty of opportunities on the Model Y. I think that's the best all-around vehicle. But again, it's not a mommy car. That's certainly not a cargo van. Risks to the downside here per Morgan Stanley are competition. I put an X there. I don't actually think there's too much competition. Maybe, though, with the Chinese domestics, I'll give them that. BYD is probably your biggest one, so we'll see. Megatech, I don't think so. Legacy, I don't think so. Execution risk with multiple factory ramps, yeah, that becomes expensive. Then you've got China risks, again, like a BYD, yes. Valuation, okay, yeah, maybe. Because, they're looking at only giving you a 12 times multiple on Tesla on their EBITDA in 2030. That really assumes that there's not going to be another growth curve that comes out for Tesla by 2030, and that's fine, right? You're assuming no massive take on FSD, robotaxis, robots. You're really not building any of that in, and that's fair. You probably do go down to a 12 times multiple by 2030 because growth would slow down without some of these other inputs. So that's Morgan Stanley's model on Tesla. I have to say, I think it's a very reasonable model here. And I think they're just a little nervous because Tesla has added $350 billion of market cap just year to date. And so you could see some downside here in the near term. Unless, of course, we get a really good positive CPI. Then, baby, Tesla boon. Someone here writes, Max actually writes here, Toyota Minivan is so good. Yeah, the Toyota Sienna is a phenomenal vehicle. I will give them that hands down. We also happen to own a Toyota Sienna. We compared that to the Odyssey, which was a close second, but I don't know. I think once we got in the Sienna, we were sold. But it's kind of weird to say. We bought the Sienna in 2015 when we had our first child. It's crazy to think it's been 8 years since we bought that car. Lauren's starting to go, oh, Kevin, my car's 8 years old. I'm like, we're not buying a new car. Minivans are underrated. I couldn't agree with you more. I think they have that bad reputation of like the mommy car. But look, short of a Sprinter van, which I would prefer a Sprinter van over the mommy van, but a Sprinter van's like, it's not really like a mommy van, right? Like Lauren's like, Kevin, I'm not taking a Sprinter van to Trader Joe's, right? Like I'm not going around with a massive cargo van. And I'm like, all right. I mean, like, fine. But anyway, I'm like, how are we going to get to Disney faster? And she's like, Kevin, we'll fly there now. And I'm like, okay. But anyway, which is also very ridiculous because instead of being like a 4-hour drive, if we fly to Disneyland now, it would be 18 minutes. But that's unfair. But anyway, so minivans are freaking phenomenal. I mean, really, they don't deserve the bad rap that they get. They have a lot of room. We have an 8-seat Sienna, and even with all 8 seats filled, which you're still climbing over each other to get to the seats, right? But once you're in, you could still put a crap load of luggage in the back. So it's like our airport vehicle of choice. I mean, it is freaking awesome, man. It is awesome. Sprinter van to Trader Joe's. I'm actually seeing more moms start taking Sprinter vans to drop their kids off at school, at least the school my kids go to, and I'm like, this is cool. People are starting to catch on in America that Sprinter vans are cool. High tops are where it's at, exactly. With the big TV in the back. When we went to Victorville, shout out to the agents there. You could actually search this on my channel. Just type in YouTube, Meet Kevin Victorville or Sunnyville. I don't know, what's it called? I can never remember what the place was called. It was some area in Victorville. But anyway, the agents rented this Sprinter van that had each row staged up another level. And then a giant TV with blackout curtains, and I'm like in a movie theater here. That was so cool. Kyler says he's in a Sprinter van right now. I love it. I'm jealous. My favorite car. And people who look at Sprinter vans, they bag on them. They're like, oh, well, that's gonna be hard to drive. Nope, wrong. Those suckers are so easy to drive. It's freaking phenomenal. They're so easy, and they turn on a dime, which again sounds ironic, but they ride nice, and I like things that ride nice.